I'm a portfolio manager at Janus Henderson. I've been at Janus Henderson for over 20 years now. Firstly started in operations and then worked my way forward into front office to become signed off as a fund manager back in 2008 once I passed my CFA. I've been involved in managing Henderson High Income Trust for the last 10 years and I'm obviously lead manager on that trust. So as the name suggests, Henderson High Income, we're there to really provide that high level of dividend income stream to shareholders, but also the prospects for capital growth over the longer term. The trust generates that high level of income by predominantly investing in UK equity shares, both large, well-known companies, but also some smaller company opportunities. But the one thing that really differentiates us is our ability to own bonds. Typically, we'd own about 20% of the portfolio in bonds, but that should be seen in the context of the gearing within the trust. So one of the advantages of investment trusts is our ability to utilise borrowings or gearing to help enhance both income returns and capital returns. You know, the way we utilise gearing within Henderson High Income is to use that gearing to invest in the bond portfolio to help generate that extra income for the trust. That's why the headline yield is quite high, and that's how we generate that extra income for shareholders. So the investment process is first and foremost one of bottom-up stock picking. What does that mean? It's about doing detailed stock analysis to really understand the companies that we're investing in for the longer term. And I break it down into three key parts. You know, firstly, fundamentals. You know, really understanding the key attributes of a company, how it's positioned in its markets, what barriers to entry does it have, who are the management team and how good they are, things like that. Then we focus on the financials of a business and the health. You know, looking at how sustainable the profits are, how robust the balance sheet is, how much it's invested in for future growth, and how much cash flow does the business have to pay us as shareholders in dividends. And it's all about finding a company with good financials that can pay a dividend today, but also can grow it into the future. And the third part, which really underpins the whole process, is valuation. It's all very well finding a company with good fundamentals and strong financials, but if it's in the price, your capital appreciation is rather quite limited. So it's about finding good quality companies with good financials that can pay a healthy dividend that can grow, but always being disciplined on valuation. So the dividend has grown over the last 10 years consecutively by average rate of about 2%. So we've delivered both the high level of income, as the objective suggests, but also delivered dividend growth at the same time. In terms of share price performance, on a total returns basis, delivered a good return for shareholders. We've outperformed the benchmark both over 1, 3, 5 and 10 years.
Perfect. Thank you very much.